So now we're going to go over corporate actions, which is almost always a test question. There's always at least one or two on splits. So you definitely want to know those. And that's what we'll go over now. Okay. There we go. So what are corporate actions? Well, one thing would be a stock dividend. Okay. Who's going to pay a stock dividend? Usually it's going to be a growth company because a growth company doesn't have a lot of cash yet, but they want to give something to their investors. So they'll go ahead and pay a stock dividend. Okay. Again, the big thing, stock dividend, not taxable when you get it. Okay. It just adjusts the cost per share downward. So here's that example. You own 10 shares, you bought it for 100. Now you own 12 shares. Each share is worth $8.33 now. Okay. So if you go to sell one of those shares, then you would pay a little bit of taxes. Okay. You pay capital gains on whatever the gain was when you sell it. So let's go over stock splits. So there's two types of splits, forward and reverse. So the key that you need to know is that they're going to go ahead and give it to you in like a ratio form. So they'll say do 2 for 1. Okay. That is an example of a forward split, whereas 1 for 2 is a reverse. Okay. So the first number is the number of shares you're going to get. The second number is the number of shares you will give up. Okay. So in the case of the first one, I'm going to get 2 shares for every 1 that I have. Okay. So that is a forward split. A forward split is usually a good thing. Okay. So the whole idea behind a stock split is that you make the stock more marketable to the general public. Okay. So companies that have done forward splits are like Amazon, Apple. Okay. Companies that basically started off at $7 a share and then they got so valuable, they were up at $1,000 a share. Well, it's hard to buy a stock that costs $1,000. It's not super marketable to retail investors like you or me. You know, if we're lucky, maybe we can buy 1 share, but we'd have to have $1,000. So what will they do? They will do a split. Okay. And they'll do a forward split. And so let's say it's a 10 for 1 split. If a stock were trading at 1,000, well, I'm going to go ahead and get 10 new shares for every 1 share that I held. So the price of each share will be reduced to $100, okay, as opposed to 1,000. The way that, I kind of explain this sometimes to clients would be, if I've got 10 $1 bills and my son is sitting there with a $10 bill, okay, well, maybe I'll offer him a trade. I'll say, hey, son, let me give you these 10 $1 bills and you give me that $10 bill. Okay. On my end, well, look, I still have $10, so I don't really care. On his end, he's super excited because he's a little kid. And now all of a sudden he's got 10 bills, so he thinks he's rich. Okay. But in essence, he still just has $10. Okay. So with splits, even though the price per share is changing, the total value is not, right? It's still just $10. All right. I don't care that my son now has 10 bills. He still only has $10. Okay. He thinks he made out well on that transaction, but I know it was a wash. Okay. So forward splits, you're getting more shares than you're giving up. Okay. And again, that first number is the number of shares you're getting. The second number is the number of shares you're giving up. A reverse split is bad news. Okay. So like I said, a forward split is usually a good thing because the stock has done so well. It's gotten so expensive. Now we need to reduce the price of the stock so we can make it more marketable to everybody else. Well, a reverse split is kind of the opposite. The stock started at a certain price and then it just dropped so low. Nobody wants to buy the stock anymore because it's trading at 25 cents. Okay. So if it's trading at 25 cents, one quick way that I could get that stock price up is to do a 10 for 1 split or a 1 for 10, excuse me. Okay. So you give me the share or basically 10 shares at 25 cents. And I'm going to go ahead and make you a brand new share and it's going to be valued 10 times that. Okay. So $25. So it's a way to like reverse engineer your stock price to go up. Okay. Again, the company is still worth the same amount of money. Total value is still worth the same. You just have a lot less shares. All right. And so penny stocks are always doing reverse splits. because nobody wants to buy a penny stock. Once the price gets below $5, they get kicked off the exchange. They can't trade there anymore. So then nobody really wants them. So what they'll do is they'll do a reverse split to try to get that price back up. Okay. But in essence, it's still probably a bad company, right? Why else would their stock keep dropping? Okay. So reverse split, bad. Forward split, good. And again, when the ratio is given to you, just know the first number is the number of shares you will receive. The second number is the number you will give up. Okay. What are the other corporate actions? Well, you have a merger, which is two companies of roughly the same size. They combine assets. Okay. An acquisition is one company buys another company. And a spin-off is a company spins off one of its other companies. So like an example of that would be eBay. eBay and PayPal used to be one. eBay spun off PayPal and now it's its own company. Okay, because the company just got so valuable. They're like, oh, well, now we can create two companies. Okay, so merger, acquisition, spin-off. A buyback. Be careful. They love to test buybacks versus tender offers. Okay. A buyback is just when a company buys its own shares in the open market. It increases the value, the shareholder value. It increases the price of the stock. Buybacks are super common. Okay, because again, CEOs get paid based off of how much the stock price went up. So one easy way to raise the price of the stock is just do a bunch of buybacks. We made $100 million in income this year. Well, let's go ahead and buy $75 million worth of our stock back. Okay. So buyback is definitely tested. It just means that the company is buying its own shares in the secondary market. And remember, those shares that we purchase, we call those treasury stock. Treasury stock is stock that's been purchased back by the company. A tender offer is different. Okay. A tender offer is where someone else, and it could be a company, okay, decides to make an offer to buy all of the shares of a company. Okay. So an example of that is Elon Musk with what he did with Twitter. Okay. He originally tried to buy Twitter via the secondary market and just through his broker. But once he got a stake of 10%, he had to disclose that to the SEC. Once it got disclosed to the SEC, everybody knew that Elon Musk was trying to buy Twitter. So the price went from like $20 to $50 a share. And so for him, he couldn't really continue to buy it through his broker because now he's paying $50 a share when he was paying 20. So what did he do? He just offered a tender offer and said, listen, all Twitter shareholders, I am willing to pay $40 for your stock. Okay. And then they vote on it, whether they want to accept the tender offer, and they'll do that. Okay. So, the tender offers are a little bit like a buyback, except that it's not the company itself buying back the shares. It's usually somebody else. But where it can get complicated is, it could be like a company making a tender offer to buy another company. Visa wants to buy MasterCard. So Visa offers MasterCard shareholders $40 a share for their stock. Okay. Because if you want to buy a company and it's publicly traded, you can't really do it in the secondary market. Okay, because it's too transparent. Everybody would know and the price would drive up and so you'd end up paying a lot more. So instead, when somebody wants to take a public company private, which doesn't happen very often, but if they want to do that, they'll do a tender offer. Okay. Another example, like Dell computers. They were a public company, but then the original owner of Dell, Michael Dell, was like, no, we're not doing very well as a public company. So you know what? I'm a billionaire. I'm going to go ahead and just make a tender offer and buy my company back. I don't want it to be public anymore. I want to buy the whole thing. So he did a tender offer. He bought back his company. And so now Dell is a private company. Okay. Corporate actions, notice needs to be given. So, for any cash dividend, you got to disclose the amount of the dividend, stock dividend, the rate of the dividend. For a split, what that ratio is. Okay, must be given. Should be straightforward. Proxy voting. So, remember, shareholders, common stock shareholders only have the ability to vote. Okay, preferred shares do not have the option to vote. So make sure you know that. So there's an advantage of common, which is that you get voting rights. Preferred shares, no voting rights. Well, if you've owned stock, I would assume you've probably never actually voted. I own stock. I've never actually voted. Because I mean, who really follows the stock like that? They actually even know when the board meets. But you can vote. Okay. And a lot of times what will happen is you will get companies that want to vote on your behalf. Okay. So let's say I own Facebook stock. Well, I don't really follow Facebook. I don't really know that much about it. You know, I'm whether whatever they're voting on, I probably wouldn't really know anyways. Okay. But you know what? There's a company, say Vanguard. Vanguard owns 10% of Facebook via their mutual funds. So for Vanguard, like it's really important to them that they have a say in who's on the board or whatever other options that they're voting for. So Vanguard will solicit my proxy. They will solicit my vote and say, Tim, can we vote on your behalf? You're a shareholder of Facebook. We're a shareholder of Facebook. We would like to vote on your behalf. And so I can go ahead and give that right to them. Okay. So that's proxy voting, letting somebody else vote on your behalf. And it happens all the time. Okay, we're going to skip the questions. Sorry. Now we're going to go over customer accounts. Okay, this section should be hopefully pretty straightforward for most of you. You've got an individual account, which is just an account with one person. Super straightforward. A joint account is with 2 or more adults. Okay, there's 2 types of joint accounts you need to know. There's joint with rights of survivorship, which is what you would have with a spouse. If I die and I have a joint with rights of survivorship account, then my spouse will just take over my account, that she will inherit the entire account. The other type of account that you can open is what's called tenants in common. Tenants in common, if I die, then the portion that is my account, or so let's say it's 50-50 between me and my brother, well, my 50% will go to my beneficiary, to my estate, as opposed to going to the other account holder. Okay. So normally, if you're opening up an account with a spouse, well, then you would do joint with rights of survivorship because your spouse is probably your beneficiary. So if you die, you just want her to get everything. If I'm instead opening up an account with a friend or with a colleague or with a sibling or something, well, I don't want my share of the account to go to that friend or colleague or sibling. No, I want it to go to my. Okay, we're going to skip the questions. Sorry. Now we're going to go over customer accounts. Okay, this section should be hopefully pretty straightforward for most of you. You've got an individual account, which is just an account with one person. Super straightforward. A joint account is with 2 or more adults. Okay, there's 2 types of joint accounts you need to know. There's joint with rights of survivorship, which is what you would have with a spouse. If I die and I have a joint with rights of survivorship account, then my spouse will just take over my account, that she will inherit the entire account. The other type of account that you can open is what's called tenants in common. Tenants in common, if I die, then the portion that is my account, or so let's say it's 50-50 between me and my brother, well, my 50% will go to my beneficiary, to my estate, as opposed to going to the other account holder. Okay. So normally, if you're opening up an account with a spouse, well, then you would do joint with rights of survivorship because your spouse is probably your beneficiary. So if you die, you just want her to get everything. If I'm instead opening up an account with a friend or with a colleague or with a sibling or something, well, I don't want my share